Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Welcome to today's Savant Live webinar, A Strategic Approach to Maximizing Your Social Security Benefits. My name is Jonathan Millican. I'm a financial advisor here in our Birmingham, Alabama office. And I also serve as part of our Savant Private Client Group team. And as part of that team, I get to work with a number of advisors here at Savant, but none more that I enjoy working with than my co-presenter today, Jeris Gaston. She is also here in our Birmingham office. Jeris has been in the industry for 18 years. She travels the world through her service to Rotary International. And as if that wasn't enough, she is also the mom to twin boys. Jeris, great to see you. Welcome to the webinar.
Well, thank you, Jonathan. You're quite kind. In addition to being an amazing hype man, my coworker Jonathan here is a seasoned planner with over 20 years in the industry, working with individuals and families. And he has a special gift. He can make even the most complicated issues more digestible and, honestly, dare I say, a little fun. So you're in for a treat today. He does this while raising two incredible girls and staying in shape with his favorite sport, which is table tennis. So I'm honored to be presenting with you today, Jonathan. And as I think back over our time in this industry, while meeting with hundreds of individuals, the most common concerns related to Social Security are, will it be there for me? How much will I get? And when should I take it? So today's topic is always timely. Thank you all for joining us. And at times it can be simple and straightforward, but at other times it can get very complicated. So what's good for you may not be good for your neighbor, but we look forward today, hopefully, to helping provide you with some more clarity.
That's right, Jeris. And so no better way to really reinforce that than the words that are on the screen. For our guest, I can assure you there is some wise counsel in these words. Every situation is unique. We would always encourage you to reach out to a financial professional to talk about those unique circumstances that you may be in. So with that, Jeris, tell us what is on the agenda for today.
So today's agenda, we're going to treat a little differently. We decided to organize it around common questions that we've been asked over the years related to Social Security. And this has come after I said speaking to hundreds of individuals over the past 20 years about what their concerns are. So we're going to start by discussing several of the metrics and mechanics of the system itself. Then we're going to review the various factors you should consider before you file for benefits. And then we're going to move into how to optimize Social Security, how to balance it within your financial plan and your retirement income strategy. And then we're going to wrap up with an action plan, and we hope to take some of your questions as well. So with that, let's, Jonathan, tackle our first question of the day. This is one we get asked a lot, and will Social Security be around for me? Well, to understand if you will even receive benefits, we kind of have to take a step back and understand why it was even started. I'm a self-proclaimed history nerd, so, and if you will, just indulge me for a moment. President Roosevelt signed the Social Security Act in 1935. It was never designed to fully fund individuals' retirement, but it does provide a very important income stream to 71 million Americans today. So the original claimant age was set at 65. And there was actually a lot of debate back then of raising that to 70 in 1935. And that probably would have been helpful with some of the issues we're dealing with today. But before we get to that, a quick fun fact for you, Jonathan. And for those out there, maybe you can share this at your next cocktail party. The first recipient of Social Security was a woman. Her name was Ida Mae Fuller. And she started collecting benefits at the age of 65 in 1940. Interestingly enough, she had only paid about $25 into the system, And Ida Mae lived to be 100 years old. So she received close to 23,000 in benefits. So the moral of this story is good for Ida Mae, but the system has been challenged since day one. And as you know, it's technically underfunded. So there's definitely going to be some type of change in the future. People are living longer. Many are electing to retire earlier. There's inflationary pressures on the system. So, and there's a lot of headlines we see every day as well. You see them, some of them may be clickbait, but not all of them are. The system has real issues, and the solutions are a bit polarizing. But there's two main camps here for the solutions. One is to increase the payroll tax, and two is to increase the retirement benefit starting age. So let's look at the payroll option first. Currently, all working Americans have 6.2% deducted from their paycheck, and the employer is required to match that. So total of 12.4%. So increasing this percent would generate more revenue into the system, but that's seen as a tax increase. The second option is increasing the benefit age, and that's just simply a political third rail. No one wants to touch it, but what it would look like is likely increasing the full retirement age from 67, where it is now, for anyone born after 1960, to 68 or 69, or decreasing the maximum delayed benefit age, which is currently 70, to something higher. So for years we've been seeing these headlines. I wouldn't let these headlines suggest that you should make a hasty decision. It's really important, and you'll hear us talk about this today. When you're making a decision about Social Security, you've got to base your decision on what's known today and not speculate or predict the future. So right now, for today's webinar, we're working under the assumption that everyone that's paid into the system will get some benefit down the road. So Jonathan, how about you give us a quick look about how these benefits are calculated?
Absolutely. So fortunately, we do not have to spend our time with me taking all of our participants one by one through how their benefit is calculated. Hopefully, you either have a Social Security statement with you, or if not, later we're going to talk about how you can retrieve that Social Security statement. So I just want to talk about some of the concepts that you will see on your Social Security statement, or at least some of the underpinnings of how that calculation is arrived at. So let's start with this concept of work credits. So pretty simple. Each quarter that you work, you pay into the Social Security system. You're rewarded a credit, 4 credits in a year, 40 credits over 10 years. So once you've hit that 40 credit mark, you are eligible to receive Social Security benefits. No bonus points for getting more than 40 credits. It's just a hurdle you have to reach in order to qualify for benefits. Next, your benefit amount is going to use the highest 35 years of your earnings. So as you can imagine, most of us had lower earnings early in a career. You're going to have higher earnings later in your career. If you do not happen to have a full 35 years of earnings, Social Security will just give you a 0 for that year or any years that are missing. That, of course, will bring your average down, so your benefit amount down. But that's kind of the underpinning of how the calculation is done. The full calculation is what you see here, the average indexed monthly earnings, or AIM. Trust me, that is far beyond the scope of today, a very complex calculation, but that is the number that arrives at, when you look at the lower left of your screen, your primary insurance amount. So that is the amount that you will receive at your full retirement age. So full retirement age is a really important concept. Let's talk about that for a minute. Again, that will be printed very clearly on your Social Security statement. For many of you joining us today, I imagine your full retirement age is age 67. If you were born in 1960 or later, that is considered your full retirement age. So that is the age, again, you receive your primary insurance amount. Consider that your baseline amount. I think that's a good way to think of that. So that comes into play. Here we are, just 10 minutes into our webinar, and I'm about to put some numbers on the screen. Let's go ahead and get those out there. So in this example, let's look at someone age 67 is their full retirement age. They can receive $2,000 a month. at that age. So this chart just visualizes for someone that chooses to take benefits earlier than their full retirement age, they're going to receive less. For someone that decides to delay benefits past age 67 in this case, they're going to receive more in benefits. I think everyone that's attending today kind of knows that's why the decision's so important. There's a big discrepancy between age 62 and age 70 on this chart. But keep in mind, this is only the amount you receive in that first calendar year. So after that first calendar year, your benefits will be increased gradually over time. And that's where the concept of cost of living adjustments come in, Jeris.
Yeah, so as you can imagine, since Americans started paying into the system in 1940, our cost of living has changed dramatically. So in 1975, the system first added a cost of living adjustment, or a COLA. And prior to that, it was up to Congress to decide what that number would be. 2 years ago, we saw a huge leap of 8.7% in that cost of living adjustment. That was actually the highest since 1981. But I will tell you, this historical average is around 3.77. Last fall, it was announced that this 2024's COLA would be 3.2%, starting this year on January 1st. And but there's been times, 2009, 2010, 2015, where we didn't see a cost of living adjustment at all. So needless to say, with the solvency issues that we've talked about, with annual increases higher than 3.77, that's not something that we should expect moving forward. So if we're working under the assumption that Social Security will be here for you in some form, then there comes the big question that we get asked all the time of when and how we should take it.
Well, Jeris, here's where I think we're getting to the good stuff. This is why people have joined us. I think of it as if we were playing a board game. We've got the game board out. We've talked some about the rules of the game. We've got several different pieces on the board and discussed how those pieces move. So now we need to start thinking about strategy. So with that kind of analogy in mind, let's start with this idea of an earnings test. So you remember my comment before about full retirement age. That really comes into play here, because what the earnings test is for someone that chooses to receive benefits before their full retirement age, then Social Security may reduce your benefit if you earn more than a certain level. So that earnings level is about $22,000 this year. So that means if you've taken benefits, but you earn more than $22,000, your benefit amount is going to be reduced. So as we think about strategy, put a pin in this concept here, because that's an important decision point. You may be thinking about taking benefits early, but really consider, is that the best choice for me? If I choose to take benefits early, which means I'm taking a lower Social Security benefit amount, and then I'm also seeing that reduced because of my work earnings during that time. Next on our chart here is the government pension offset and windfall elimination provision. So again, this is a really complex situation. If you fall in this category, though, reach out to us. This is usually very unique to each person's situation, so we're happy to talk through those details. Frankly, it's just outside the scope of what we can cover today. Next is taxation. So never a fun topic. Really, no one wants to pay taxes. You say, how is it that I pay taxes on my Social Security benefits? That hasn't always been the case, but now, in fact, it is. So typically, and I imagine for many of you that are joining us today, you could see as much as 85% of your Social Security benefit be taxed. So the reason I say many of you may fall into that, the threshold, and I'll use a married filing jointly couple from the tax standpoint, that threshold is just $44,000. So if you reach that $44,000 level of income, and the way Social Security defines that income is your gross income, so think all of your earnings that you've got, plus your municipal bond income, typically not taxable, but we're going to bring that in, and then half of your Social Security benefit. So your gross income, muni bond income, half of your Social Security benefit. If all of those are greater than $44,000 for a couple, then you're paying taxes on 85% of your Social Security benefit. Last, I'll mention Medicare, just because it is so closely tied to Social Security. It's even referenced on your Social Security statement. When you look at that, Jeris shared the example earlier of Ida Mae Fuller. So she started benefits at 65. That's the way the system originally worked. Now we've decoupled that benefit start from age 65. Even though everyone still takes or begins Medicare at age 65, the timing of when you begin Social Security benefits is not dependent on that age 65, but that's the reason that we tend to think of those together. So I mentioned some of the changes we've already seen in the timing of when we start benefits, but there was probably no year where we saw more changes than back in 2015, Jeris.
Yeah, Jonathan, we do want to take a moment to address some of the strategies that have been phased out, because there's a lot of buzzwords here and key strategies that are just no longer there. The Bipartisan Budget Act of 2015 was passed, and this is the legislation that updated the rules on claiming. These updates were really designed with the solvency of the system in mind, and it was also trying to eliminate these aggressive claiming strategies. So some of these techniques might sound familiar. File and suspend was a very popular one, or restricted application. If you were born after 1953, these are no longer an option for you. So Social Security also imposed some new deemed filing rules, and I'm going to go over those in a minute in a little more detail. What's an important distinction here is that the survivorship benefits were not affected by this legislation. So there's still some advantageous claiming strategies for survivors, ex-survivors. So we're going to address this in more details in a minute as well.
So let's talk a little bit about this, Chair. So what is the goal as someone is thinking about receiving benefits? So I'm curious, in the individuals, the people that you've talked with, I mean, what do you hear from them as far as, hey, here is my goal as I'm considering taking benefits?
Well, I mean, most people want to max out their benefits, but they don't want to miss out on them. So, you know, I joke with people a lot, and I say, well, tell me how long you're going to live, and I'll tell you exactly when to take Social Security. It's that simple. If only it was that simple, right? Unfortunately, it doesn't work that way. So as financial planners, we like to start thinking about the goal first before we think about the tactics and the strategies involved. So what are we trying to solve for? What are we trying to accomplish? And what we're aiming to do is maximize the total amount of benefits over your lifetime. That sounds logical, but there's typically a trade-off, because in order to do that, we have to defer them. So it's important to start by taking a long-term mindset, Jonathan, about your total long-time benefits, not just what you can get next year. Longevity plays a huge part in that decision. I've heard many people say, well, I might not live that long, so I want to take the benefits now. And I'm sure you've heard that countless times too, Jonathan. So we've got to work through that uncertainty on longevity and think more about the goals of each individual. Your claiming strategy should be to protect against a longer than expected life. If you do live a very long time and end up depleting your nest egg, it's important to have the largest Social Security benefit as a safety net, really, to help manage that longevity risk. So if your lifespan ends up being shorter than expected, depleting your nest egg isn't as much of a risk. So it's important to think also, and we're going to talk more about this in a minute, about spousal and survivor benefits. If you're married, we need to shift the focus from your lifetime total benefits to the benefits as a couple. And because it's not just a single life expectancy to think about, it's the combined one. So as I said, we're going to tackle that in a minute. There's a lot of considerations here. Another thing I hear about often is, what's my break-even age? So Jonathan, I'll let you tackle that one.
Yeah, I think the best way to think about or to talk about a break-even age is to have some type of a visual or a chart. Wouldn't you know, look what I've got here. So this is how we illustrate this to individuals that are considering this decision. So as you look at the chart, we've got three lines. We have a greenish line there for someone that begins benefits at age 62. We have a dark blue line for someone that begins benefits at age 67. And then that gold line is someone that begins benefits at age 70. So you can see the time point, or the point in time where those lines cross, somewhere in that early 80s range, right? 80, 81, 82. And this holds true in virtually every case that we look at. So as we go back to what Jeris has been talking about, if your goal, if your hope is to maximize your benefits, then the first question is, again, the one that Jeris asked, which none of us really know, but how long will you live? Well, statistically, we see today that someone that's age 62, their average life expectancy is age 86. So if you're 62 today and you live to age 86, we look at this graph and it tells us our break-even age is around early 80s. So what that says is if you want to maximize benefits and you think that you will live to that life expectancy, then you would be better off waiting, right? Because once you exceed that break-even age, you're going to have received more in benefits after that point than you would have received if you would have began earlier. So I mentioned earlier about kind of putting a pin in something. I would put a pin in this as well, because this is really a hallmark of your decision-making process. How long, based on what you know about your health and family history, do you think, how long do you think you will live? And use that to help make the decision about, should I delay benefits? Can I push benefits later in life? Or should I think about taking those earlier? And again, as Jeris said, right now we're really just talking about retirement benefits, but there is a variety of types of benefits that Social Security provides. So Jeris, I'll let you walk through those.
Yeah, absolutely. So Jonathan made the analogy to this webinar being a game. This is the strategy section of the game. So all the information mentioned thus far is referencing the individual that pays into Social Security taxes. So we're going to talk a little bit about the benefits available to spouses, divorced spouses, and survivors as well. This is really the meat and potatoes of this. So for spousal benefit for a married couple, there's some strategies to consider for sure when taking benefits. As long as you've been married for at least 9 months and you're at least 62 years old. So that max benefit for a spousal benefit is equal to 50% of their spouse's primary insurance amount at full retirement age. So if you try and claim the spousal benefit before your spouse reaches full retirement age, that benefit is reduced. However, there is no increase in benefit if you take it after their full retirement age. A little bit of strategy there. So if you're eligible to receive your own benefit and your spousal benefit, Social Security is going to give you the higher of the two. You're not going to be able to get both. Here's how I like to think of it. And I like to drink wine sometimes, so indulge me in this. Imagine that Social Security benefits were 2 bottles of wine in a wine cellar. One bottle is your benefit amount, and the other one is your spouse's benefit amount. So prior to 2020, you could enter that wine cellar 2 times, choosing one of the bottles the first time, and then later you can go in and grab that other bottle now that it's aged and it's a little better than before. However, now if you turned 66 on or after 2020, you can only get 1 pass at the wine cellar. So you choose 1 bottle and you have to get the best bottle when you go in there to get it, the one with the highest benefit. And so you are deemed to have chosen the best one. And this is that deemed filing rule that I briefly mentioned earlier. So, and I don't want to get too granular because I feel like with every rule there's an exception, and there's an exception with this one as well. But I'll mention it in case it applies to anyone out there. Let's say you turn 62 and your spouse hasn't yet filed for Social Security. You can claim your Social Security at age 62 and then make a switch to your spousal benefit if it's higher when your partner files. But your claim would still be reduced. from what it would be because you took it earlier, before your full retirement age. Is that as clear as mud, right? Like I said, lots of nuances here, but I thought I'd mention that exception because it does exist. It's not one we see people do often, though. So let's move on for the sake of time. I do work, and Jonathan does as well, with many divorcees and widows. So the next few areas is one where we spend a lot of time coaching individuals through their options. One question that I get in this area that I'll address off the bat is that if you are eligible to take Social Security on your ex-spouse's record, that does not affect their ability to take Social Security at all. So, and stop. But first, you have to know if you are eligible to even receive this type of benefit as a divorced spouse. So, if your ex-spouse is living, then you have to be able to say yes to a series of questions. 1, were you married for at least 10 years? 2, are you currently unmarried and at least 62? And 3, does your ex-spouse qualify for Social Security, and is your benefit less than theirs? So if you say yes to all of those questions, then you may be able to receive benefits on your ex-spouse's record. A few things to note, your ex-spouse doesn't have had to apply for benefits for you to apply, but they do have to be at least 62 years old. And you must have been divorced for at least 2 years. Sounds pretty straightforward, but we get a lot of questions about that one because, as you can see, there's a lot of moving parts. I'm going to skip survivor on minor children and come back to that in a minute and go to widow and widower benefits. If your spouse passes away, and Social Security assumes that you've been married at least 9 months, that's their timeline, you can expect to receive a widow's benefit if you are 60 years old or older. If you are disabled, this age is 50. This benefit will depend on your age and on the amount your deceased spouse was entitled to at the time of their death. This goes back to the strategy of the higher earning spouse delaying benefits to 70 to maximize not just their own benefit, but to maximize the widowed spouse's benefit. Remember, like the spousal benefit, you can get either your spousal benefit or your widow's benefit, whichever is higher, but you can't get both. So a few things to note here: if you remarry before age 60, you can't receive the widow's benefit as long as that marriage is in effect. If you remarry after age 60, you will continue to receive benefits on your deceased spouse's record. Going back to minor children, children of retired, disabled, or deceased worker are eligible to receive dependent benefits if they're under the age of 17, and as long as they're attending primary or secondary school up to the age of 19, or if they were disabled over the age of 18, or excuse me, they were disabled before age 21. So minors can receive up to half benefit of the family member's full retirement amount. So as you can see, in just those 4 categories, there are nuances, there are exceptions to the rule, and we certainly suggest for you to speak with somebody about your situation currently. And so that said, we're going to turn attention in our next question to our agenda, which is, how does Social Security fit into my retirement income plan? And Jonathan, I'm going to turn it back over to you to start us off there.
Yeah, I mean, that's a great way to segue from that. I mean, it's Jeris, as you just covered, so many nuances in that. I always think of individuals don't need to know the rules, don't need to know all of the rules. They just need to know what the rules are for their particular situation. So I think this is an area where the work that we do at Savant can be so powerful. If I think back to 2015 and some of those changes that were made that you covered, there were a lot of options that were removed at that point. In a way, it's never been easier for individuals to assess their own situation in a vacuum, meaning just looking at Social Security benefits. What is my strategy to maximize those benefits over my lifetime? What I think can be more difficult, though, is then taking those Social Security benefits and seeing how does that fit into my larger retirement income plan. So I'll show this visual here. This is a software program that we have access to. And really the purpose here is showing multiple different claiming strategies. So you can see different ages that each spouse may receive benefits. It shows the amount of benefits they receive over a lifetime. And it's also referencing a success, a probability of success, which in layman's terms means what is the likelihood that you will not run out of money? So there are a lot of variables and assumptions mixed into this, but this is how you take that Social Security decision, fit it into a larger context. And from here, we would dig in even to another layer. So I'll show this visual. So now we get into where is the cash flow actually going to come from that's going to fund my expenses, depending on what strategy I choose. So the visual we're looking at here is someone that has purposefully decided, I'm going to delay my Social Security benefits, going to wait about receiving those early in retirement. And instead, I'm going to be drawing from my investment accounts, maybe IRA accounts in the early years of retirement. So you see on the graph here, we've got these light blue lines there around year 2025. That's showing investment account withdrawals that are happening in order to fund expenses. By doing that, those dark blue lines, which is our Social Security income, are allowed to be higher later in life. So another thing that this does by delaying those Social Security benefits, now we have a window from the time we retire until Social Security benefits begin, that we may be able to implement some type of tax planning strategies. Think Roth IRA conversion, something there where we have this unique time where we don't have taxable income that is as high as it has been in the past and likely won't be as high as it is in the future. How do we take advantage of that window of time to do some things that we're not going to have the ability to do at other points in life? So on the flip side of what we're looking at here is you may have someone that says, for whatever reason, maybe health concerns, maybe they would just prefer to go ahead and begin Social Security benefits earlier, kind of that bird in the hand mindset. So instead of delaying benefits, they are going to have those dark blue bars happen much earlier on the graph. And as a result, they will not be relying on their investment accounts as much, right? Those investment accounts stay invested, they're able to grow over time. So it depends on, again, kind of what your strategy is going in. But I do think there is a benefit in taking whatever that strategy is and comparing it to the other resources that you have and to see how that fits in to that bigger retirement income plan.
So Jonathan, we've thrown a lot out today. I like to end my meetings with kind of what are our next steps? What are our action items? So the first action item is, where do you find your benefit? Some of you might remember receiving a green piece of paper from Social Security in the mail, but over the past 20 years, the Social Security Administration has, mailed out fewer and fewer of those, again, as an attempt to cut costs. And they really want you to go online and check your benefits. So many of you might already have a login to ssa.gov. And if you do, you might have gotten an email recently. I got mine last week saying that Social Security is changing their login information, redirecting you to a different login. Now, we're going to talk about some red flags when it comes to this government agency in a minute. One of them being it's very unlikely that you'll get emails from Social Security, but this is actually legitimate. And the new way to access is to go to access Social Security or ssa.gov is to go to login.gov. So if you go to ssa.gov, it will prompt you to do this. You can see in the screenshot that we have here that you will, it will direct you to it. So if you already have an account with login.gov or id.me, then you are set. However, you'll have to redo it if it's ssa.gov. So once you have access to it, might take a minute, that's when you'll be able to see where your benefits are, your past earnings, making sure you're getting credit for everything that you've put into the system. So next steps, another general next step is to make sure you're evaluating your Social Security benefits and really take inventory of other benefits that might be available to you. This is the spousal, the ex-spouse benefits, survivor benefits. Social Security website has a lot of great resources. Again, talking to an advisor is also a helpful step in thinking through these. You know, making sure you're looking at your break-even age, making sure you know what strategy that's best for your total lifetime benefits. Finally, just making sure we integrate those Social Security strategies into the bigger picture, like Jonathan mentioned. Weaving in taxes, your investments, your returns, and any other income sources that you may have. They all fit together to create a plan that's unique to you. So, of course, a Savant advisor can help you think through all of this. So here's the public service announcement that I was mentioning earlier. These aren't questions we get, but they're things that we see that have and can affect the people we work with. So recently, the Social Security Administration announced that they've seen a dramatic increase in the amount of scamming attempts. And so they recently have distributed some good information that we want to pass on to you about Social Security scams. The first is, it's always important to keep your guard up. As I mentioned, Social Security Administration will very rarely communicate with you via email. When I got that email last week, I had to cross-verify a lot of different places. Certainly didn't click on any links in the email. I went to ssa.gov myself because that is we don't want you to click on links in emails from an email you find that might not be legitimate. Scammers are going to pretend that they are from an agency or a familiar organization. They'll say that there's a problem out there and that you need to address it, often by paying money, or there's a prize you've won and you need to send money in order to redeem it. And they're going to be really pushy. They're going to pressure you into acting immediately. So certainly, and unfortunately, they're good at their job. So their job is to try to get money out of you. So Jonathan, how can we avoid this? I know you've had this issue.
Yeah, so I would say a few things. As you were saying, I think scammers' hope is that they catch you at a vulnerable time. They catch you at a busy point in your day where maybe you don't have your thoughts together. Before you know it, you've shared some personal information, Social Security number, something like that with them, when maybe normally you wouldn't if things were more calm. So I would say anytime someone's reaching out to you, they are the one that's initiating the contact. Good rule of thumb, make a note of who it is that is contacting you and just hang up. Then, go find a reputable phone number if that's the way that they reached out to you. Return the call or call that agency, that Social Security in this case. That don't use a phone number they've supplied to you. Use one that you found in an independent kind of resource. So that, and as you said, it's rare that Social Security, even the IRS, are going to reach out to you by phone. They much prefer the U.S. mail than they do phone, or certainly text or email. So just be wary. Some other good tips on the page here as well.
Yeah, and if something like this happens to you, the main thing to know is to report it as soon as possible. Report it to the Social Security office, to the Inspector General. And I would say put your pride to the side, because the quicker that you act and to help protect your privacy and your information, the better. So keep your guard up. Certainly don't succumb to these bad actors at all.
Here's one, Jeris. So it says, Jonathan, I have lost my Social Security number. Can I borrow yours? Okay, well, that's clearly a scam. We've just come off of that series of slides. I think we know that answer. So yeah, let's not. No, you cannot borrow my social security number is the answer to that question.
Yes, please do not give someone your social security number. But I do see a real question for you, Jonathan,
Okay.
that hopefully you can shed some light on. I'm going to read this. Do survivor benefits to a widow begin as soon as their spouse passes away?
Yeah, great question. So, unfortunately, we do have, cases where someone loses a spouse, and that happens early in life. Maybe they've already attained those 40 credits that I talked about towards the beginning of the presentation. So they're eligible for benefits. How does that work? Well, I go back to what you shared, Jeris. So that the surviving spouse has to be age 60 before benefits can begin. And age 60 is the minimum. Then all of those same criteria come into play that we've been talking about. If that surviving spouse begins benefits when they're age 60, then that means they're taking a reduced benefit. So the longer they wait, the larger their benefit amount can be. So a little bit unique in that beginning age, it being age 60 there, but a lot of the same criteria are really going on there as we think about that situation. So got another question here, Jeris. Let me see. Looks like I'm going to pitch this one to you. So it says Medicare premium increases.
That's a good question. Well, as you mentioned earlier, those are a bit decoupled now from the benefit side of you take Medicare at 65, but Social Security age has been increased. But the Social Security COLA is separate. I mean, we do see Medicare Part B premiums increase. Typically every year we saw a 6% increase for the base tier this year, and those premiums are typically deducted from the Social Security check. And honestly, it's kind of unfortunately, is an example of the government giveth and the government taketh away.
Again, to everyone that joined us, we really, really, really appreciate your time. Genuinely appreciate you spending part of your day with us. So if you have time, visit us online at savantwealth.com. Or again, hopefully you had a chance to click that link and set up that phone call. Again, appreciate your attendance, and we hope that you have a great day.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.